All right, so class, good morning, and welcome to our lecture on IAS 7, um, cash flow. IAS 7, we are looking at statement of cash flow. Statement of cash flow. All right. Now, when it comes to cash flow, our main objective for preparing a cash flow is basically two reasons. So we have just the objective of preparing a cash flow or a statement of cash flow is number one, to provide information, all right, about the historical changes in the cash and the cash equivalent of an entity, okay? All right, so the information about the cash and cash equivalent change. So we are talking about the historical changes. Historical changes in the cash and the cash equivalents of an entity. You can also say a reporting entity. All right. So that is one of the reasons why. And again, to also do some clarification, all right, or in terms of reporting, we call it classification, all right, to classify inflows and outflows under the headings of operating, investing, and financial activities. All right. So the purpose of this classification is to aid comparatives, all right, so that we can be able to do comparative analysis. All right. So don't be surprised if your ratio question is about analysis of cash flow. All right. Cash flow is important because, like we've said, the importance of this is that you have an entity who is providing information. And as such, the users are really interested, all right, because users need this information. They need the cash flow information, the statement of cash flow information, all right, to be able to deal with or get to know of the liquidity of the entity or viability of the entity, or to also check the financial adaptability. How well is this entity being able to adapt in terms of its financials? All right. Now, those of you who have gone through the study of financial management, you realize that, so for the finance manager or for finance management, you realize that cash flow is the key determinant, it's a very key determinant of the worth of a business. Yes, because we use it to value a company, all right, of the worth of a business. And in finance management, you also realize that businesses have to pay dividends, and dividends is paid with cash, all right? It's paid with cash. So we want to know how much the entity is worth. Again, one of the reasons why we stick to cash flow is that profit, on the other hand, is manipulative. Profit is manipulative. In that, look at the way we value our inventory. There are so many ways. There are so many ways. So our inventory valuation, all right, and if you have learned your IAS 8 well, you know that accounting policies. There can be changes in these valuation. All right. Again, another item is depreciation. Depreciation is a non-cash item. People can use it to manipulate because of accounting policy or accounting estimate of choice, reducing balance and straight line method. Again, provisions. Provisions, whether it is provisions or allowance for bad debt, IFRS 9. All right. Or allowance, we call it allowances on receivables, trade receivables, whichever one it is, whether it is provision on legal cases, IAS 37, whichever one it is, you realize that these are estimate based. All right. And therefore, profit, if you rely on the profit, it is very, very manipulative. The creditors also need to know the cash flow status because they are thinking about how the company's ability to pay them. So bear in mind, creditors too want their safety. All right. Do the company, they are giving their resources to have the financial viability to pay them. Management accountants also use cash flow. And for them, it's for future decision making. All right. They use it as a basis for future decision making. So you see in your man accounting, you'll be doing budgets and stuff. All right. So that is that. All right. So that is the necessity or the importance of cash flow. Of course, it may have some disadvantages. The fact that profit is manipulative doesn't mean cash flow is not also manipulative. That's the disadvantage part of it. Cash flow can also be manipulative, especially when it is getting to the end of a business. Yeah. What happens is that instead of people paying, they want their cash flows to look good. And instead of paying their payables, they keep the money to cross the year. Then they pay immediately after the year. And so that the cash flow in perspective for that particular year end will look good. But sometimes you have to assess this thing by looking at the subsequent event. Yeah, event after reporting date. You have to check those things a little. Yeah. So base that is that. And it is very impractical to have a record for cash flow only. You are in your company, you are filing for other stuff, you want to file for cash flow things also. It's just an extra cost, all right. And cash flow is like a battle against accrual accounting. Yeah, so because cash flow does not kind of allow provision and all those things, it is a battle against accrual accounting. All right, so but when we talk of cash flow, one thing you need to understand is that we are looking at, so the cash flow embodies, so when we say cash flow, it actually embodies cash on hand. All right, cash on hand. Okay, so including overheads. So cash on hand, cash at bank. All right, the physical cash you are holding in your office, that's petty cash, and the cash you have at bank. All right, including overdrafts. So overdraft will therefore be like a deduction. Yeah. Now, it also includes what we call demand deposit. Demand deposit. Very short term, deposit. Then we also talk about cash equivalent. Of course, when we talk of cash equivalent, we are talking about those ones that are very short term and very highly liquid. They are highly liquid. Highly liquid to the extent that these highly liquid investments are readily available for you. All right, you can convert them. So readily convertible to known amount of cash. Known amount of cash. You know that you can convert it into cash without any significant risk. Without any significant risk. of change in value. Because there are some of them, if you go, the value is massively below what you want. A typical example with this, what I can give you will be the treasury bill, the T-bills. If you know commercial paper, these are finance. Commercial paper, bankers' acceptance, bankers' acceptance. All right. Even certificate of deposits, set of deposits. Yeah. And if you know some of the money market funds, all right, so these are examples of the cash equivalent that you have. Now, the next thing you need to try and understand about cash flow is the format. There's a format we use to do cash flow. There are two things I teach. I teach the what I call the elements, which is the operating activity, financing activity, investing activity. Then we talk about the methodology, right? The methodology is the direct and the indirect method. But for your exams in reporting, the direct method is not examinable. What we examine is only the indirect method. So how do we do the indirect method? So in terms of the methodology, we stick to the indirect method. So that one, let's say you have the name of the entity. All right. Then the heading. So statement of cash flow for the year ended, or cash flow statement. For the year ended, whatever date, 31st December or whatever date you can put there, you just put there. All right. You rightly underline this. Then you put your currency. We are in Ghana. So let's put in our currency. If you have to put zeros there, put zeros there. If you have to put millions there, whatever you have to put there. Now, the first thing you do is to reconcile your profit. All right. Reconciliation of the profit. And so what you will start with is your profit before tax. Start with profit before tax. All right. Then you make your adjustments. Do your adjustments to the profit. And I'll give some little explanations to these things. All right. So if you know your IAS 1 very well, you know that when you start from profit, you look up. When you are looking up, the first thing you will see probably after that is finance cost. All right. Finance cost, you add it back. Now, I tell my student that when you are looking up, anything that is deducted, you add it back. Anything that is added, you deduct. And these are what we call the things that you have to add back. I mean, from to be able to get your operating profit. All right, you add because finance cost is not actually something that is part of your trading activity. So, so you see that most headings start with this one. We are talking about operating activity. Operating activity. All right. And finance cost is not an operating activity. It isn't. It's about you going into some long-term debt or lease or whatever it is that they are. It is not part of your regular activity. So certain things that are not part of your regular activity inside your P&L is the things that you are adding back or you are subtracting, depending on whether it was already added or it was already deducted. So that is what you do. So look, so don't go and add back your operating expenses because those things are already operating. Revenue is operating, cost of sales is operating. So you get your gross profit. After your gross profit, you learn selling and distribution. All right. So those selling and distribution are operating items. So you don't touch them. We are adding back the non-operating items and we are adding back non-operating items. So finance cost is a non-operating item. All right. So we add it back since it was deducted earlier. Then the next thing you will see, another thing that is non-operating is investment income. Of course, the name of it even suggests it. It's investment income. You see, those ones will be added in your P&L. So here we subtract. It's like we are readjusting the operating profit. So the things that were not operational, we are taking them out. That is what we are basically doing. Of course, what you see in your cost of sales or probably your administrative expenses, another thing, these are non-cash items, depreciation or impairment or impairment. You can even add amortization depending on whatever it is. All right, amortization. All right, so those ones you add back. All right, so what you should understand is that for these two, they are not operating items. Okay, they are not operating items. And that is why we are making the adjustment oil. So what do? We have to do this adding back and subtraction in order to get back to the P&L from the operating activity. So you adjust it in order to get the P&L itself from operating activities. All right, so that is why we do that. These are not operating activity items. All right, so you add back depreciation. If there is any gain or loss on disposal, understand that disposal too is not a trading activity. It's not a trading activity. When we say trading activity, we are talking about those ones in your ordinary course of activity. Get the understanding, it will help you. Ordinary course of activity. All right. So that is what we mean by operating. Ordinary course. What the person does daily. All right. What the person is set up to do. Now, if you do a gain or loss on disposal of PPE, of your PPE, that one is not something your company is set up to do. You trade, yours is revenue, not gain or loss on disposal. So you have to understand these bits of cash flow, all right? So that is why if it is a gain, don't forget if it is a gain, you will see it added in your P&L. And therefore, since we are readjusting it, what do? We will now what? Subtract. And if it is a loss, don't forget that in the P&L, loss are deducted. Here we will add back the loss because we are readjusting the profit before tax. All right. Yeah, so that is that. Another thing that you probably see there is also provisions. Provisions. So increase or decrease in provisions. All right. Now, you realize that if you've been following my lecture, some of the things I tell you from my early senior high school days is that I was taught that increase in provision is treated as expense and a decrease in provision is treated as what? An income. Now, what does that mean? So if it means that if we increase our provisions increase is treated as what? An expense. And if it is was treated as an expense, what do we do now? We add it back because we are taking it off. And if it was a decrease, it would have been treated as an income, just like these incomes, just like these gains. What do? We will add that one back. All right. So sorry. Since those ones were increased, which were income and were added, we will rather deduct from it. All right. So that is that. All right. So take note of that. Any grant amortization, grant income amortization, grant income is not also coming from your trading activity. All right. It's money that has been given to you by government. All right. So what do we do with that one? We take it off because when the grant income comes, we add it. All right. So that is that. So here we will take that one to off. All right, because we want to get those things that are purely coming from what? Our trading activities. All right, so you realize that these ones too are non-cash items. These are non-cash items. So all non-cash items must be dealt with. Okay. Grant income too is not something, it's not from trading. It wasn't from trading. So that is why we need to deal with it. All right. Other things you may probably see in your exams, which may include increase or decrease in prepayment. All right. You have increase or decrease in accruals. So accruals is just like provisions. All right. All right. So every increase is deducted here in terms of prepayment. Why? Because you could see clearly that you prepaid and cash what went out. All right. So there is an outflow. That one is a payment. There is an outflow. All right. So if it is decreasing, what does it mean? It means you are collecting some of the money back. All right. The reverse is the case here. Increase. All right. What do? You add back because increase in accrual is just like increase in provision. Accrual is a provision. So the reverse is this. All right. So you add all these things up. All right. This is a operating profit before working capital. So adjusted operating profit. Adjusted operating profit before working capital. Because the next thing for us to do is to bring in working capital movement. So I advise that if you are looking at your operating activities, this is what you need to do. So for your operating activities, look at your P&L and your current assets and current liability. So P&L and what? Working capital. So the entire P&L thing you watch out for. Then in the balance sheet, what do you look out for? Your working capital. These two. All right. So now let's do what we need to do here. So what we will do is we will have to compare. Working capital comprised of three things, right? Yeah. So is there an increase or decrease? In the first one will be what? Inventory, which is an asset. Then increase or decrease in receivables, trade receivable, which is also a current asset. So they move together. All right. Now, if your inventory is increasing, then it means cash is leaving you. Why? Because it means you are buying into your stock. All right. You are increasing your stock and it increases by you buying. So cash is leaving you. So increase will be an outflow. And this one too, the same thing. Increase will be an outflow. Why? Because if your receivables are increasing, then it means that you are not receiving money. You are not receiving money at all. If you have been receiving money, it would have been cash sales. But as the receivable is increasing, it means your cash are leaving to your debtors. All right. The reverse, the decrease, rather, if your inventory are decreasing, it means people are buying and cash is coming in. If your receivable are increasing, it means they are paying you. Therefore, it means what? You are receiving cash. All right. Then we come to increase or decrease in trade payables. Trade payables. Now, what is your understanding about that? Your understanding about that is that if your payables are increasing, it means you are not paying. It means the cash is being with you, and therefore that one communicates inflow. If your payables are decreasing, it means you are paying, and if you are paying, it means money is what? Cash is what? Leaving you. All right, so that is that. That is that. All right. Now, if you do this, you will now get your cash generated from operating activity. All right, the cash you have generated from operating activity. So that is that, cash generated from operating activity. So like your operating cash, all right, operating cash flow. And don't forget, operating cash flow is before what? Interest and tax. I hope you know that. And so the next thing for us to do is actually what? Deduct what? Interest. So interest paid, then tax what? Paid. Somebody will ask, what about the investment income that comes after finance costs? Okay, so those things you classify them as what? Investing activities. All right, no more operating activities. So these are payments and they are all what? Outflow. All right. Later on, you realize that I will show you how to get these things, and these things will be coming from your workings number 3 that I'm going to be doing with you. Workings 3 that we will be doing. All right. Items like gain or loss on disposal will be coming from workings 1 that I'll be doing with you. Even with depreciation to amortization, they will all be coming from workings 1 that I'll be showing you. All right, so this is what you have. Now, if you now do this, then you have what? Net cash flows from operating. Net operating cash flows. All right, so basically that is that. Then the next category of things is coming from our investing activity. So we look at investing activities. Investing activities. All right, the things under this one will include proceeds you get uh, uh, from a PPE purchase. All right, from purchase of PPE or sale. Oh, sorry, I said purchase. Purchase is money leaving you. All right, so therefore here, if there is a purchase will be outflow. So purchase of PPE. So sale of what? PPE. If you sell the PPE, the proceeds you get is an inflow. If you purchase a PPE, the proceeds that will be leaving you is an outflow. All right, so that is that. And later on, you realize that these two things will come from workings 1 also. All right. Now, what else can we bring in? Yes, the grant that we talked about. So the grant received, grant proceeds, government grant proceeds. It's a cash that you receive, and so that one too will come here. If there is any investment you've done somewhere, the interest, all right, remember I told you the investment income, all right, that you receive is an inflow here. If there is any other interest in the form of dividend you received, all right, you received, that one too is an addition here. So you total all these things, you get the net cash flow from net investing cash flow. All right, so that is that. The last aspect of the element is the financing. Financing. All right, somebody will say, what the interest? What if the interest is coming from an investment that I did somewhere that is there? So the classifications now depends. All right, that is some of the disadvantages of the cash flow, where certain things should be are not really clear. All right, so let's say they said that if you invest in a business, all right, then you are getting the returns. Some people say, why isn't the dividend not a financing activity? Because you finance somebody, all right, and you are getting a dividend. But it doesn't matter. It's also another form of investment that you did, all right. So from financing activity, any proceeds from issue of shares. Now, if you want to know where these things are generated from, look at your NCA, all right. your NCA part of the balance sheet. That's where you can source the information from. All right, that is where you can source it from. So take note of that. Then this financing activity, it means you have to look at your equity side and also your long-term liabilities or your non-current liabilities. So that is where you look for these things. So the proceeds from issue of share issues. All right. If you issue share, you get cash. All right. Then what else can you bring? Any proceeds from loan. All right. If you take loan, they give you cash. Okay. So that one too. All right. Then all your payments like lease liability payments or loan payments, lease liability payments, loan payments. All right. All those payments is a cash outflow. Dividend payment. All right. Also is an outflow. All right. So later on, you realize I'm going to show you a workings, and these liability payments may come from your workings too. And dividend payment will be coming from your workings 4. So total, you have your net cash flow from investing, financing, sorry, net financing, cash flow. All right. The good thing about cash flow is that when you get it wrong, you will know. And when you get it right too, you will know. Now, once you are done with this, then you bring your cash and cash equivalent brought down. Those ones are the beginning of the year. At the beginning of the year, you add it. And after adding it, everything should be equal to your cash and cash equivalent at the end. So basically, that is that. All right. So if you do it right, you get it. Okay. So that is that. But most importantly is this part. You just have to be careful because sometimes the determination of the depreciation and also the other things are a little bit tricky. So now I'm going to give you some steps, all right, that can help you in solving cash flow problems. So what you're going to do is that to be able to get all these figures and have a satisfying cash flow to balance, so what you need to do is to try and get some formalized approach to this. So for me, my advice to you is that you take your step one. Step one is about the adjustment of the profit. So you do the adjustment of the profit. So start with your profit before tax. Then you start with your profit before tax. Then what? So I say start with profit before tax. After you have done that, just look up. You are looking up to deal with non-cash flows like depreciation, amortization, gain or loss, all right? Then non-operating activities. Non-operating activities. So anything that is not actually an operating activity. If that thing was deducted before, you add it back. If that thing was added before, you deduct. All right, so that is it. That is that. So look up and deal with those ones. Then your step 2 is to do these some series of workings. The workings, the underlying truth is that you should be doing workings for each of the items in the balance sheet. Everything in the balance sheet, you need to do a workings for it. The workings should cover all of them and things in the P&L as well, including things in the OCI. But there are 4 fundamental workings I want you to know, which will help you get most of the figures. So workings number 1 is about the PPE workings. And the PPE workings will help you to know most of the things. All right. So you will need the PPE, the balance brought down of the PPE. Then the things that we normally add to our PPE include what? Revaluation, surplus, revaluations. Then if there is any right of use assets coming from lease, because you can acquire asset via 2 main ways, via lease or via purchase. So asset purchase. All right, asset purchase. You see, one thing you should understand is that when it is a right of use, you don't pay direct, you don't pay the money. And so it's a right of use as you've not actually finished paying everything to have it. So that one is an addition. But when you purchase, it's a cash outflow. All right. So understand, it's just that here too, it is increasing your asset. So when you purchase, I'll come back to the thing that you saw here, purchase of an asset outflow. I'll come back to that. But when you purchase over here, what you should understand is that you are adding up to your PPE because your asset is going to increase. Then what are some of the things we deduct from our PPE? Depreciation, isn't it? All right, we deduct depreciation. We also deduct disposals. So the disposals, we deduct the carrying amount, okay? The carrying amount. All right. So that is what happens. Then these things should be equal to our balance carried down, which will always be given. Brought down and carried down will always be given. So if it is not balancing, then it means it is coming from one of the items. Most of the time, it is usually this one that is not found. So it means if you've seen it, then that is it. You can pick it up to your investing activity. All right, immediately you finish this one, remember to do the gain or loss on disposal. The gain or loss on disposal. And the gain or loss on disposal is given by the proceeds you receive. Don't forget, this is the proceeds that is going to your investing activity. Don't forget. Minus the carrying amount of an asset. And I think by now, when we say carrying amount, everybody should know what it is. It is the costs minus all depreciations. So minus all depreciations, accumulated depreciations. All right, so that is that. So this is investing. If you found this, it is also going to investing. All right. As what? An outflow. This is going to investing as what? An inflow. Then this gain or loss is the thing that I said, if it is a gain, what do you do? Because gains are already added up there. What do? You deduct. So this thing will be going to, if it is a loss to, you add back. This thing will be going to our operating activity. Our depreciation that we need to add back can be sourced from here. All right. Now, if it is a right of use, then it means that we need to start thinking about workings too, which is lease liability payment. The lease liability payment. So that is that. Now, over here, what do? We have the lease liability brought down. Which includes the figures that we will have in this, our CL and our NCL. Everybody who has done lease IFRS 16 know that there are 2 figures always about that in the balance sheet. So you put the 2 together, you bring down. Then the new lease during the year, which is coming from this side, this one. All right, so that one too, you add. Then These two should be equal to your lease liability carry down. All right, both the one in the CL and the one in the NCL, current liability. All right, so that is that. If it is not, then it means there is a lease payment. There was a lease liability payment. All right, and that payment will be probably it's a payment, so it's an outflow. All right, so that is that. So that gives you two of the major workings. Then workings number 3, you need to try as much as possible to do will be the interest and tax. The interest and tax. All right, the interest and tax. All right, for the interest part, what do? We will need a interest brought down, balance brought down. So it can be sourced from the CL. All right, balance brought down. Then the finance cost in the SPL, in the profit or loss account, will be added together. It should be giving you your balance carry down. If it is not, then it means there was an interest payment. All right, there was an interest payment. All right, the other way around will mean that probably you received an interest. For the tax, also, you will need your balance brought down, which is coming from DT, deferred tax in the NCL or NCA, because depending on the situation, can be a deferred tax asset, deferred tax liability, and your CT. So together, what you have, you bring it here. Listen, I know these things are deductions, but I've kept them in positives so that the other side will be what? The negative, which is the payment, all right? So the tax in the SPL2 will come. You add it. Then if it is not equal to your tax value, the balance carried down, which comprises of your DT and your CT, the missing one will be what? The missing one will be tax paid. So that is that, tax paid. All right. The last working for you, which is workings 4, is to help you determine how much dividend has been paid. So you will need your retained earnings brought down. So this one is about dividend payment. All right, or any dividend received, the reverse. So you need the brought down. You need what? Net profit for the year. Net profit, which is coming from the SPL. You add it up. It should be equal to your retained earnings carried down. If not, then it means that dividend was paid. All right, so that is be the missing figure. All right, so that is that. That is basically what it is. Now, what we're going to do is to start practicing. All right, so this is a simple thing about cash flow. We need to start practicing what we've just done now. So let me bring up a question and let's practice. All right, so that is that. All right, so let's look at this example, this short illustration. So we have the below are the financial statement of single for September 2012. Then we have the statement of financial position. So we have this. All right. So you could see clearly something like this. From 2011 to 2012, you see that there has been increase over here. All right. So like I said, you need to make sure that you have done a note for each of the item inside the balance sheet. Every item has been taken into use in any form of workings or those ones that you do directly inside the cash flow. So here too, the same thing. Make sure you have used every figure. All right. Then you take care of the notes too. All right. So this is my advice for you. In case you have a cash flow question, I always advise students, your answer booklet, especially those writing in hard paper, especially the Ghanaian CA, you have 20 pages of your answer booklet, 20 pages, and you are answering 5 questions, which means that technically every 120-mark question should take 4 pages. So don't be a miser about the pages. Don't do that. Don't do that. So if you are doing this cash flow work, it means that do the cash flow on the 3rd page. All right, which means that the first 2 pages will be what? For your workings, because the workings are very, very important. That is it. Or you can start the cash flow itself on the first page. Just use 2 pages for the workings. It's as simple as that. All right, so now let's see how we go around this. Of course, so for me, because of screen, what is going to happen is that I'll set up my cash flow here. This company was for single. So I have single. Then I have statement of cash flow. Or cash flow statement, whichever one the requirement says. For the year ended, write everything in full. All right, you are doing it. For the year ended, we have 30th September 2012. Rightly underlined. I bring up my CD sign. Is there a need to put 0 zeros at the top? It's rather even in millions. All right, so that is that. Like I said, you start with your profit before tax. What is the profit before tax? It will be shown in the P&L. Profit before tax, I have 46. All right, so I put there 46. That is it. Don't forget, this is cash flow, so you have to show that you are in the operating activities. All right. So that is that. You start with your profit before tax. And I said, what do? You look up. Look out for non-cash items. Look out for non-operating items. So, like I said, these are operating expenses. So they are operating. So don't touch it. Just right after this, you saw finance cost. Yes. So you have it is deducted. So you have to add it back. So add back finance cost. You are adding back, and it is what? 3. Once you finish this, because this question is simple, there's no investment income, go and look for the rest through your workings. So let's go to our workings. Let's go to our workings. So we read the question. We are not told anything inside here about depreciation. There is no accumulated depreciation here because this thing is prepared in IAS 1. So what do you see? You realize that you need to do your workings 1, which is on PPE, which will help you find most of the figures. All right. So you look at this PPE. PPE brought down, balance brought down is what? And this is you doing workings for each of the item. So balance brought down is what? 60, right? So you have balance brought down. This is the closing balance of previous year will be the opening balance for the current year. So you have your PPE here being 60. All right. So that is that. So let's put our millions here. It's 60. All right. What do we add? Is there revaluation in the question? If there is revaluation in the question, you'll probably see the revaluations in an OCI or in the notes. You don't have anything like that. So this is the note. The note is about the disposal. Then we have trade payables, including accruals and interest payables. All right. So that one should help us with our interest calculation. All right. And the accrual thing that we also mentioned. All right. So now we have our PPE, the balance brought down. We don't have any revaluation in the question. Is there any right of use we didn't have? We didn't have such in the question. So we move on to addition. Is there addition? We don't know yet. And most of the time, like I said, those will probably be the missing figures. So we go straight and do depreciation. Do we have depreciation? The question told us that depreciation is 17 for the year. So minus 17. Question also told us that they dispose an asset. So disposal with carrying amount. It says that with the carrying amount of 9 million was disposed for how much? 13 million. Don't forget I said the disposal is always the carrying amount. So 13 million. So that is what we have. All right. Oh no, the disposal carrying amount is 9 million. Sorry about that. It's 9 million. All right. So that is what we have. This should be give us our balance carry down. Our balance carry down from the balance sheet is how much? 90. So you do realize that I have exhausted these two figures. I've used them in the workings. So if I add everything up, let me add up. I have 60 minus 9, 17 minus 9 is 34. If I deduct it from the 90 that I have here, you realize that there has to be an addition of what? So an addition of 56. That is what I have here. And this, don't forget, is an investing because you have acquired. Immediately you do this, I told you to do a gain or loss on disposal, right? On disposal. Bear in mind, you have found depreciation. So you know where it is going. Sorry, this is it. You know where it is going. All right. So gain or loss of disposal, how much was the proceeds that we collected? The question is said the proceeds that we collected is 13 million minus the carrying amount of 9 million. What does that give us? That means that there is a gain of what? 4 million. What do we do to the gain? We go back and add the gain and also deduct the depreciation. Sorry, we go back. It's a gain. So gains are usually added back, all right? In the P&L assistance, like I said, inside the P&L, what do we do to gain? Gains are already they are already what? Addition. So what do we now do? Since it's a gain, we adjusting it means that we are going to less what? Gains. All right. So we will add back depreciation. What was the depreciation? Our depreciation that we had was 17 according to the question. So this is it. Then the gain that we also had, all right, gain on disposal. Normally, like I said, in the usual P&L, a gain is added, but here, since we are adjusting, we will deduct. All right, so that is basically what is going to happen. All right, so after we have done this, I mean, we've exhausted this. All right, so we've done our this part. Is there any increase in provisions, any increase in all those things that we spoke about? Is there any increase in provisions? We didn't have any provision in this question for now. We didn't have any provisions, but we were told that the trade payables that is there, trade payables over there, includes accrual for interest payment of 4 million. Last year, that thing was what? 1 million. So this is to help us that we can do a workings on interest. You can actually do a workings on interest. All right. So basically that is that. And we will subtract that figure from the payables. Okay. So we will know our real payables inside there. All right. So let's now go to the next thing. So if there has been increase in accrual, increase in, so this one said that what is that? Includes accrual of interest payment, accrual on interest payment. So what we can do is to use those two figures to determine our interest calculation. All right, for this thing we added back. So now let's go to increase or decrease in working capital. You see, we've done this. We are coming to these ones. So what do you see there? There is increase in inventory. Increase in inventory. And what does that mean to us? It means there is an outflow. All right. How much is that? Show it. Show that it's 32 minus 20. So show. All right. It doesn't matter how you position this. You can also do it 20 minus 32. But you should understand that it's an increase and it's an outflow. Trade receivables. It was 27. It has decreased to 20, which means that a decrease in trade receivables. What does it mean to us? It means that, so we have 20 minus 27. What does it mean to us? It means that we've collected some of the monies, and therefore that it is to us an inflow. So we've exhausted these two. We don't touch the cash. Don't forget, those one will form our opening balance and our closing balance. All right. Then we come to our trade payables. Have you seen it? So what happened? Decrease in payables. Decrease in trade payables. All right. So what does that mean to us? Our payables were 25 last year. This year it is 23. What does it mean? It means we are paid, and if we have actually paid, then it means money is leaving us. But you have to be careful, because the question said that included is in this 23 was a 4 million, which was for finance cost. Don't forget that. So it means that if we take the 4 million out, we'll be left with 19, right? And it says that last year's own too included a 5 million, which means that this one too will be what? 20. So this is it. You have to be very, very careful about that. All right. So that is that, which tells us that the decrease in payable is actually how much? It's actually 1. And if it is 1, it tells us that we have paid. All right. After we are done with the cash flow, we have to total it. Okay, so let's total. So we started with 46. We add 3. We add 17. We minus 4. We minus 12. We add 7. We minus 1. So that gives me 56. Immediately I'm done with this. Don't forget, what did I say you do? You go and do the other workings. All right. There was no lease. So the other workings, will be left with workings 2, or you can call it workings 3, whichever number you give it. All right. So that is that. But make sure that, like we did, these depreciation that you brought in here, reference these things with workings 1, so that the examiner will know where the figures were picked from. All right. So that's very important you do that. All right. So you could see that we've also exhausted this part, our current assets, we've used them. All right. So now let's do our interest calculation. So we were told that for the interest, the balance brought down should be 5 million, right? From this. All right. Then the finance cost in the SPL. In the SPL, what did we have? The finance cost in the SPL is how much? The one that we actually added back is 3. So we have finance cost of 3. So we have that one. This should mean that our balance carried down, which according to the question is 4. There is something. So there is interest payments, right? Of, I think that will also be 4. All right. So you see it rightly spotted there. What about our tax? What do we do? What is the balance brought down on tax? I don't think there's a deferred tax. Okay, there is a deferred tax here, and there is a current tax here. All right. So what then do we do? So this is the deferred tax here. Deferred tax brought down is 14. All right. And so we will add, we have 14 and the current tax is what? 11. That gives me 25. So question is, what if the tax is in asset? So if it is in asset, it means you have to put this side is into brackets. All right. If one of this is anyone that is in assets, you have to put it into brackets. All right. And negate it thereof. What is the figure in the SPL for tax? 12. We have it here, 12. So 12. So which means this thing should be equal to our balance carried down. The balance carried down, we had deferred tax for 15, and we have current tax for 12. All right, that gives me like 27. Is that not it? Sorry, it's positive 27. So if it is not equal to, then it's a tax paid or a tax credit. Let's find out. This one should give me 37. Okay, so it means there is a tax payment of what? 10. So I have my tax and so from my workings 3 can come here and do interest paid and tax paid. All right, if that is the case, for all from my workings 2 in this case, so workings 2, I had tax of 10, I had interest of 4. All right, so that is what I have. Okay, so together, my 56, if I take 14 out of it, my net operating cash flow gives me 42. So I'll put it here, 42. Then I come to investing. So the investing activity, what do we have there? In my investing activity, don't forget there was a disposal of asset and there was also a purchase. So don't forget the purchase of PPE coming from my workings 1. The additions that we worked for was what? 56, right? So I bring my 56. And from my workings 1 again, there was a proceeds from disposal, which was 30 million, if I remember correctly. So the proceeds. So this one is an outflow. Then we have 13 as an inflow. All right. How is that? Is there any dividend received? No. We don't have any interest received. Nothing. So we can close out this. So for my net operating, minus 56 plus 13, my next investing activity gives me what? 43. That gives me 43. Negative. So it means already this thing is -1. Let's see. Let's go on. See. Then I come to my financing. So you see that we've used these things. We've used this one, this one, this. We've used it. The only things we've not used is the share capital. So investing, so share capital, financing, share capital is giving me what? Share capital is giving me the fact that it was 5 and now it's 30, meaning that share capital has increased in terms of cash by 25. Then I look at my retained earnings. What do I do with retained earnings? We do a workings with retained earnings, you remember? So the workings with retained earnings, how do we go around it? So we use it to determine dividends, right? So that will be workings 3, dividend, if any, whether paid or received. We have retained earnings brought down, which is 35. Then net profit from the SPL was what? Profit after tax is 34. So we bring in the 34 now. which should be equal to my, if it was a loss, please, you less, which should be equal to my balance brought down, my balance carried down. That is the retained earnings carried down, 60. If I add these two, I think I have 69. So it means there's a dividend payment of 9. So it means that here, I'll do dividend. So we don't bring the retained earnings just like that. So it will be a dividend what? Paid, which is coming from workings 3. And that is a dividend payment of 9. All right. So it means I've exhausted this. The next thing left for me is the loan, right? Loan was 29. It's now 10. So it means it's a loan I've paid. Loan repayment. Loan repayment of how much? That's like 19. I've paid 19. So that one will be 29 minus 10, which means I have paid 19. All right. So everything is exhausted. I use this. I use these workings. I've used these ones. I've used everything there. So that is what you do to make sure that you get most of the marks. You do everything. Make sure you've captured everything. Nothing is left behind. So what has happened? I have 25 minus 9 minus 19, right? So I have -3. Why is this thing so that of a negative? So I have -3 here. Let's see what will happen. So that is -46, right? You add it, it's -46. Then this one, -46 versus 42. That gives me -4. So net cash flow is 4 negative. So that is the net cash flow. Then my cash and bank. So now I'm coming to use it. Cash and cash equivalent. Brought down. Brought down is 12. Okay, so that makes it, you see, 12. And it should be equal to the carry down. So you have cash and cash equivalent. Carry down. So if you do everything right, you have it. And it is 8, which means it has balance. So that is how you do a cash flow. All right. So just take it systematically, but make sure that you have exhausted every line in terms of working and also presented in the cash flow. If you do that, you stand a chance of earning more marks. All right. So that is that. That is the approach that you must use to solve a cash flow. All right. So what I'm going to do is to pick up a past question. Then we delve into the past question. All right. And we good. Okay. So let's pick a past question. Okay. So let's look at this. We have this information granted us, and you now need to take a look at it. All right. So look at it. Finance cost began it. Investment income is there. Profit is there. Less tax. You look at this one, so you see your NCA. You see these ones also there. Your equity side. So you see, you can even pick some of the things immediately and score some marks. Okay, you don't leave everything in hanging. All right, so you have these, you have these. All right. Additional information tells you depreciation is this. Asset has a carrying amount of this to be disposed of. So you are supposed to prepare for geofrost. And I think it's a very simple question for us to deal with. So as usual, you start. This is geofrost. All right, and you have statement of cash flow. So this video will certainly have a part 2 where we practicalize more questions, all right? So here we are supposed to prepare these things up to which period? October 2017. As usual, don't hesitate with your profit before tax to score that tick. How much is the profit before tax? Let's go and look out for it. Profit before tax is 15. So we have to start with that one immediately before we lose up anything else. So it is 15,000. Immediately we look up, investment income is there. What do we do with it? It was added, we deduct. There's finance cost. These things are not operating things. So please don't forget operating activity is what we are looking at. So finance cost is how much? 400, we add it back. All right. So if you're able to do this, the remaining comes from buyer workings, right? And we said that. So what you need to do is to go straight and do the other workings that will help you get the other things. All right. So let's go and open the workings. So let's do our PPE working. So we come here, we pick this first item. So brought down, balance brought down is what? 26,574. That is what we have. What did the story tell us? It gave us depreciation. So we have depreciation, we have disposal too. Were there any other additions here we have to take note of? So we only have depreciation. And how much is depreciation? There's no OCI item. Depreciation is meant to be 4,658. All right. So we have depreciation. So just like the other example that we did, we had depreciation. If you remember, we had depreciation. We didn't get much of the other things. So there was disposal. There is an addition. All right. So just the same thing. All right. The same approach. If the other things are there, you use them. They are not there, you don't create them yourself. So addition, we don't know yet. But there is a disposal. And the disposal, we record the carrying amount, right? It says that an asset with carrying value of this were disposed for a profit. So be careful, a profit, which means the disposal carrying value, you have 1974. All right, which means our balance carry down, which we were given in here to be 43282, should help us find this. So let's find it. We have 26,574, all right, minus 4,658 minus 1974. Okay. So that gives me 19,942. Now, if I compare it with this, 43,282, that gives me 23, means my addition is 23,340. Don't forget, this is an outflow in investing activity. Don't forget. Depreciation is shown here. All right. And don't forget to do your gain or loss on disposal immediately. How much is the proceeds? We don't know the proceeds, but we know the profit is 720, which should be equal to the proceeds we don't know minus the carrying amount of 1974. That helps us to find the proceeds, isn't it? So what do? We take the 1974, we add the 720. So if I add the 720, it tells me that this place is what? 2694. So that is the proceed also going to investing activity. So be very careful. The examiner can be tricky. So we found out that depreciation is what? 14658. So we add it back. So 4658 added back. Then the gain on disposal. So like you know, gains in P&L is always added. Now we know it, we are deducting. So it was 720. All right, that's what we have here. Now that we have this, I think we are done. Can go up and look at our current working capital. What do we have on the working capital? What do we have on working capital? So what we have on working capital, what do you see? We have inventory, and is it an increase? It's a decrease. And what do we see? It was 9635 minus 3560. Please, it's important you show these little workings, all right? Very, very important. It's part of your mark. 35 minus 3560. And that gives me 6075. It's a decrease, meaning people bought inventory. All right, then I'm having a cash inflow. All right, what about the receivables? Receivables is an increase. So increase in receivable, what does it mean? It's an outflow. It means that my money has gone to my debtors. 6405 minus 4542. So 6405 minus 4542. That gives me an outflow of 1863 over here. Okay, so that is that. Then what about my payables? What happens to my payables? It's an increase, so increase in payables. Look at this, oh, that is basically what we are doing. Increase in payables. All right, so how do we go around it? We have 7562 minus 4364. It's increased, meaning it's an inflow, right? All right, so that is that. We have 4364, 7562. Inflow of 3198. Okay, so basically that is that. When you finish, what did I say? You total. All right, you total. Okay, so if we total, what happens? We have 15,000 minus 180 plus 400 minus 4658 minus, okay, no, plus 4658, sorry. Plus 4658 minus 720 minus 6075. No, that one too is a plus. 6075 is a plus. All right, minus 1863. Okay, plus 3198. Okay, so I'm having around 26,568. All right, so that is it. Then what do we do again? Don't forget, the next thing you do is the interest and the tax. All right, the interest and the tax. Now, how do we do the interest and the tax? This question is such that you don't really see you having the interest in the question, but you still have to do it. You still have to do it. So all the time, like I tell people, it is always there. It is always there. You have to rather find it and use it. All right, so now let's do the workings on those. Oh, my machine is getting slow. All right. So now let's find it out and use it. Okay. So we do on the loan, the interest. Where were we doing our workings? Wow, my machine is getting slow. The figure we had here included 8. So let me add it. That 8 included. All right. So now let's move on. So we have our interest computation. There was no lease, so that one will become our workings too. All right. So interest and tax. All right. So now what do we get for our interest? What do we get for our tax? You could see clearly that the interest, there is no balance brought down. You don't see anything. So your balance brought down is actually 0. But you have a finance cost in the SPL, right? Which is 400. And your balance, 400, sorry. And your balance carried down is also 0. Now, what does that tell you? What that tells you that the interest has been paid. Okay, that tells you that the interest has been paid. Now, if the interest has been paid, then what do you do? Since interest has been paid, is a deduction. Interest paid, 400. So you have it. Then the tax balance brought down was how much? Is there a deferred tax in this one? No. So we only have this concept for tax. Always check out too in your asset. There may be tax there. So be very, very vigilant. All right. So this is the tax. Our balance brought down is 2760. All right. Then the one in the SPL is 4350. Then our balance carried down is 3020. What does that tell us? Definitely there is a tax paid. There's a tax paid. All right, and how much is the tax paid? The tax paid can be obtained by doing 2760 plus 4350 minus the 3202. That tells us that the tax paid is 4090. So that is what we have for tax paid. So you have these two figures that you can now pick and go and start your work with. All right, so let's just go in there and slot in the figures. All right. $400 and what? 4090. Interest and tax. 400. Tax paid 4090. That will give us our net cash flow from operating to be how much? So 4090, we are adding it to the 400 and we are deducting it from 26568. That gives me, if my figures are correct, that gives me 22078. All right, so that is what I have. All right. Now, investing. Investing, don't forget the purchase of the asset. What did we get? From our workings. 23,340. The proceeds. What did we get? We work the proceeds. The proceeds is how much? 2694. So like I said, just show the examiner where the figures are coming from, all right? All right. Is there any dividend received? If there any interest received? Not yet. You could see clearly that you could find out from your dividend workings, all right? Whether it's a dividend that is paid or dividend that is received. So let's just do the dividend calculation. Retained earnings brought down 6465. Net profit after tax 10,650. Balance carried down 16,115. What is the difference? So I have 6465 plus 10,650, deducting that from 16,115. 1,000 is a dividend paid rather. Thousand. All right, so it means we can close out our investing. There is an investment income they received over here. 180. Don't forget, investment income is money that they received. But we took it out of the operating activity because it doesn't belong there. All right, so investment income if you remember our format, investment income. So they had an investment income of 180. All right, so that is that. So now, what do we have here? What we have here is 23340. We are deducting 2694 and again 180. So that gives me something like 20466. All right. Then lastly, we are financing, right? So good news for us. We've kind of exhausted all the figures here. We've exhausted our figures here too. We are now over here, including our, we've done taxation, we've touched trade receivables. We are just left with these aspects. So what happened? It increased. So proceeds from equity capital. You see, proceeds from equity capital has increased. So it moved from 17. So we have 19,365 minus 17,496. All right. So what do we have? 19,365 minus 17,496. That gives me, wow, I've written into this. So let me just keep it somewhere here. All right. So please bear in mind, okay, let me just, wow, machine is slow. Okay, so we said the equity, right? And we had 19,365 minus 17,496. So that is 1,869. We look at the retained earnings, we realize that there was a dividend paid of how much? 1,000, right? All right. Then we also look at the loan. The loan was 10,000, it means we paid loan payment. So 10,300 minus 8,000. So 10,300 minus 8,000, meaning we paid loan of 2,300, an outflow. All right. So what are we left with? This is an overdraft. So we are basically done. All right. So this, we add it to that 10,000 and you deduct it from the 1,869. You are getting 1,431. All right. I think this side too should be this. All right. So we can add to get our net cash flow. Okay. So what is our net cash flow? So we have these figures. So this one is adding on to 4466. And we are deducting it from 22,078. So I have 181 positive. So net cash flow is 181. 181 positive. That is the net cash flow. Now, what do we do next? If you have our net cash flow, what we are going to do next is what is the cash and cash equivalent brought down? So brought down. We have 10 0.63, but there is also an overdraft. Where is it? Overdraft of 429. Then we have the carry down, which is also the carry down is also 2045 minus 1230, an overdraft. So it means that whatever we do, this side is the last one, 4025 minus 1230. Okay, so it means whatever we do, we should be having something around 815. So let's see if it balances. So 1063 minus 429. So that gives me 634. Does it balance? I add it to my 181. Oop, that is it. We go. So that is cash flow for you. Make sure you have tackled every item in your cash flow. All right. Okay. So the second video on cash flow will probably look into the CA pass question and some other questions. All right. Thank you very much and have a great day.